Taking a look at interest rates today, the 10-year, a big mover. We saw the 10-year today price around 123.13 near the close, but the high of 123.17 and a low of 122.23. And really, you just got to focus on the Fed. The Fed was in focus today, and the Fed came out with a significant message, a much softer message than what the market had already anticipated. And with that, we saw rates go to 2019 lows. The yields now being pushed lower as the Fed basically indicated that they're going to stand pat probably for the rest of 2019. And the market wasn't anticipating that strong of message, so we saw the yields kick down. 10-year 2.528 on the low end of the range. So again, down to 2019 lows, breaking through that intraday low on January 3rd, and now going down to lows that we have not really seen since January 8th of 2018. So we continue to see this downside pressure on rates as the Fed and central banks across the globe soften their message. I can tell you when you look at it from a technical standpoint, looks like 249 would be a little bit of a support level, and then probably back to the 242 level, which is going back better than a year and a half ago. So where we saw some possibilities of some support from a technical standpoint, but certainly when you look at this decline in yields, appreciation and prices, it's quite significant, and it does look like it has a little bit more room to run before it runs into any major support line from yields or resistance in pricing. Also, I want to point out that the data, that's the Fed is really feeding off that, and the data that the markets realized in the last few weeks or last month or so has been conducive to what the Fed indicated today. And when you look at manufacturing slowing, not only here, but also across the globe, but we continue to see the consumer fairly strong, so that plays into that thing. And wage inflation is up, but not to a level where the Fed is overly concerned. So you have all these dynamics in the marketplace right now playing into the feeling that the Fed basically has indicated that they want to support the manufacturing production growth areas, and by doing so they're initiating some things that the market didn't anticipate, particularly when you look at the roll off of the balance sheet. They're going to slow that down or actually stop it in September. That's another data point that came out today that's very should be focused on. So overall, the Fed message today was much more dovish than the market anticipated. We saw yields go to new 2019 lows in the 10-year.